Hey, welcome back. Looking at the basics of cycle analysis today. So this is the second part of the new material added in 2019 on cycles. So a couple of things we want to really focus on is obviously explaining how the annual cycle conforms to cycle theory, describing two methods of detrending price, really important when we're looking at these massive moves and we want to try and get rid of the main trend so we can zero in on some short-term cycles that are happening there. Restate common seasonal tools. So what are some common tools that we can use for that? And then going through a number of notable economic cycles and some of the names. You definitely will get questions like, what's the longest cycle? Which cycle goes for 8.5 years? And things like that. So you'll have to put those out in a table and make sure that you memorize them. And then we're going to look at a couple non-linear cycles as well. You know, it's important to look at those and make sure that you're aware of those for the exam as well. Again, cycles, it's a great topic. I really do enjoy cycles. I think there's a lot of benefit as technical analysts that we can get out of cycles. But yeah, let's jump in and have a look at the slides. All right, so we've got a number of natural cycles, and immediately you can see in our image, the first one that we've got there is a group of planets and the times that they take to go around the sun, but also synodic intervals as well. Now, this may be one of the first times that you've ever come across the discussion of planets as far as technical analysis, and a lot of people can get a little bit bent out of shape. What I would ask is please put aside any preconceived ideas. Just like in the previous session we talked about Hurst's nominal model, that's the same here when we're dealing with planets. You know, it's the starting point for cycles. They are influential cycles that occur in the markets. You know, in Optuma we have add-on modules for people that want to do astrofinance work. And, you know, as I've built those modules over the years, I think now coming on 18, 19 years I've been working on that. It's always fascinated me, the correlation between what is happening out there with planets and what is happening in finance charts. It just doesn't make sense to me, you know, why this is having an effect, but it does. So from a purely scientific point of view, you know, I can't explain why it has an effect, but I do know that it does. So again, these are the nominal cycles. Again, like we said with Hurst, you know, we can start with seasonal, yearly, that sort of thing. We could start with these planet cycles and say, right, let's put on a cycle length of this amount of days and see whether this security tends to follow that, particularly in commodities. It's a huge area in commodities. If you're dealing with some of the corns, the wheats, etc., oil, you know, huge. It's, again, really funny to me, but nevertheless, oil, if you were dealing with oil, you would want to look at Neptune cycles. It just has an effect on it. If you're dealing with technology, then look at Mercury. This is just things that we've seen. So again, do I think you need to memorize these cycles? No, I don't. I really don't think you're going to be tested on this type of stuff, but I do think an understanding of it is what's important. And again, as Carl Crystal talks about in the text, we see that, you know, we can consider Earth to be the dominant cycle to our markets, you know, the year. Mercury is almost a perfect quarter harmonic or a fourth harmonic of that dominant cycle. Mars is almost a perfect half harmonic or double the length of that cycle. So, you know, some interesting patterns there. Even when you look at the distances from the sun, what we see, excuse me, is that a lot of the distances follow a Fibonacci cycle, which again, it's always fascinating looking at all that stuff. So again, what we said here, their period is set by a natural event, and this can be planets, it can be other events, you know, things as well. Just a minor point there. So Mercury, its cycle around the sun is 87.9 days, Earth days. But the synodic period, so Mercury traveling around is 87.9 days, but from Earth's point of view, for Mercury to be that point in the sky and then go all the way around and come back to that same point takes 115 days. So we call that the synodic interval, or the number of days for the synodic length there. And it's really interesting that Mars is the longest at 780, and then everything else gets a lot closer. And that's because these other outer planets travel so slowly that Earth has actually done a revolution pretty much by the time they've moved just a tiny bit. So that's there. Again, I'm not sure if you're going to get tested on this. This is new content for 2019. But as I said, there are many people that use and base a lot of their technical decisions on this type of cycle length and using these as nominal cycles. So again, we want to use these as a starting point. I think you need to have the understanding of them. Again, another example is the lunar, new moons, full moons. There is a lot of evidence where we see turning points in the market. You talk to any emergency services personnel, they'll all tell you that around the full moon, they're busy. There's a lot of crazy things going on. ERs are the busiest around full moons, and there's a lot of research to suggest that. Again, why would the moon have that effect on people? I don't know, but it does. Why does the market have a high percentage of turning around full moons and new moons? I don't know, but it does. So it's definitely something that should be considered as well. So the lunar cycle, it's a good short-term cycle that we can observe. Many tops and bottoms are on new and full moons. Some quantitative study should be done. It's one of those areas that I'd love to come back and do more work on. One of these days, I'll write some papers on it. Seasonality, got a lot of slides here, a lot of content in this chapter about seasonality. It's really an annual cycle. So we expect seasonality in a lot of the commodities like corn, soybeans, etc. Even things like lumber. Lumber, we have quotas on there. So when there's a lot of people, and there's been a lot of harvesting of lumber, and everyone's got lots of room in their quotas, prices are pretty low. As we get near the end of the quota and there's still demand for lumber, but people can't harvest, the companies can't harvest timber because they've filled their quotas for the year, then the price goes up. And then the quotas all get reset and the prices come back down again. So, we see these type of cycles going on. So sometimes they're seasons, the weather is leading to the seasonality. Sometimes it's government that leads to it, those sorts of things as well. Sometimes it's to do with just planetary things. Heating oil is definitely affected by the weather. We expect the season to be there. That's kind of weakening, we notice, because there's a lot of alternative forms and there's a lot more efficiency, and so we don't see the same things that we saw like 30 years ago. Forward contracts on commodities can carry a charge for storage, and so that has an effect as well. So when we're producing the commodities and they're not going to be consumed for a number of months, and they have to be stored, well, then the prices are carrying that storage cost in them. And then as we get closer and closer and the storage costs component gets smaller and smaller, we may see a price go down, even though the value of the commodity actually isn't going down, or the cash price isn't going down. We do see the forward contracts holding that. Most agricultural products will drop in price during harvest, as there is often not enough storage and the storage fees are quite high. Quotas and limits affect prices as well. Obviously, if you are buying commodities in US dollars and your currency is not US dollars, you have to consider currency fluctuations as well. Globalization has impacted previously obvious seasonal patterns. That's kind of what I was saying before. with globalization and so many people now contributing, and you've got the southern hemisphere and the northern hemisphere feeding in, significant amounts of commodities at different periods of the year, it kind of has softened out what was once a really obvious, clear, tradable pattern that we could follow. All right, so looking at seasonality and how we view that. So we use a seasonality chart in Optuma to do that. And so what we're looking at here is saying, okay, let's take the 10-year period from 2009 to 2018, and let's look at every month. What was the performance of that security for January? And then we go back over all the 10 Januaries and we average out the performance. And so we can see the behavior there. I would hazard a guess that the quotas are getting reset around this point, and then suddenly the price of lumber drops as we get into this period here. There are a number of influences on the different seasonal patterns. Silver and gold, jewelry is always in constant demand, but when we get into periods of uncertainty, or volatility starts to increase, obviously silver and gold are still treated as a hedge against inflation, and so people are buying those as well. So it's a little bit of a mix. The seasonal pattern or the big influences are more of a macroeconomic influence there. Copper's used heavily in construction and linked to the housing industry. You'll often hear copper talked about as Dr. Copper because it's like it has a PhD in economics, and it's a really good guide to how the economy is going. And it's used as, in CMT3 we talk a lot about coincident indicators, economic indicators, and forecasting, leading and lagging indicators, and copper is one of the ones that we use in there. Agriculture, obviously dependent on the growing and harvesting season. Airlines, airlines are affected by oil prices. So there's a seasonal pattern that we can see there to do with what's happening with oil as well. And of course, heating oil is affected by weather. All right, seasonality charts, again, as I said, they give a overview of the securities seasonal cycle. So it gives us an idea of what we can expect over the next period. Now, this one's really interesting. This is seasonal as of December 2018. And you can see that the trend is usually low. December's usually the lowest, about just under 3% down is the typical behavior there. But December 2018, this little diamond here tells us what this period, this month, and heating oil was down 10%. Now, right now, December 2018, we have had an unseasonably warm December. So as much as this is futures and there's always this forward aspect to it, already the futures are well down in price, which I think is to do with this warm winter that we're having in the US at the moment. So the plot shows us the expectations for the months coming back. So I think as the next season rolls around, we'll sort of come back. And that's always the case. Even though we have these seasonal patterns, there's always going to be these exceptions to the seasons that we see as well. Another way of viewing the seasonal pattern, because here we've got just the value, what is the average value? But, when we talk about statistics, we're going to talk about that the average is hiding a lot of information. So often we use these box and whiskers where, the middle line here is the average value. And then we take the first standard deviation of all the observations, and then we take the lowest observed value over that 10-year period and the highest observed value. So you can see that even right now, as much as we have, a value which is much lower than the average, well, it's still within the first standard deviation of the observations. And still definitely, the worst case scenario, the worst December in the 10-year period was a 20% drawdown. Or a 20% fall in the heating oil futures. So we haven't seen that. So what we've got is not unreasonable as well. So I like to look at this when I look at seasonality charts as well. I think that's an important chart to look at. Another way of using seasonality, and this is what is talked about in the text, is having this seasonal index. So not just, okay, is January up, but February down, and then March is up, is to say, all right, let's add them together as we go. So we get this yearly pattern, which is an expectation of what we can see in the next year. So we start low, we go up, and it comes down into March, and then massively up as summer occurs and the futures are getting pushed out there, and then a bit of a flat line through summer, but then towards the end of summer is where we hit our peak prices before we fall into winter again. That's the pattern, that's the seasonal pattern that we've seen on heating oil over time. Now, if we were to move that window back, so that's the last 10 years, but if we were to go back to 1998 to 2008, well, what does the pattern look like? And we can see that again, we tend to go up through the start of the year. These patterns continued to go up through summer and then got flat as we went into the end of summer, fall, and into winter. So there's been a bit of a change, but mostly if we sort of jump back and forth. Now, again, December's value here is what's squashing that chart up. This chart doesn't have the ability to ignore that. So we do get a little bit of a compression there. But nevertheless, you can see that, you know, the big difference is it seems to be the last 10 years has had a fall at the end of the year, whereas previous to that, the decade before that, didn't have such an effect. So it's very interesting to do that research and look at those variations as well. All right, so detrending data. The next section here in the text is all about detrending data. It is so important because when we have these massive moves, you know, it can be really hard to identify different trends. And even when we start identifying, let's say, a yearly pattern, well, it'd be still nice to take the yearly pattern out and look to see what lower cycles are evident in the data. And so getting a little bit beyond what we do here in CMT1, but we'll talk more about that in following years as well. So the trending nature of price charts can make it difficult to spot the cycles. So what we use is many different techniques to detrend the data, which makes them more obvious to us. Obviously, not all securities need to be detrended, like the VIX. You know, it's a range of values. You know, it doesn't have this trend like the Dow Jones, which was in the teens, you know, 100 odd years ago and is now up at 20,000. You know, we don't have that. So we don't get this massive trend in things like the VIX. There's two important issues that we need to consider when it comes to detrending data. The black swan events, outliers. When you get an outlier, it can really damage the detrending calculation. Now, because for a lot of detrending we use averaging as part of the process, the way that we handle that is to use the median value instead of the mean value, is one way of dealing with that. You know, when I've got a set of numbers or a set of values, and we talk about this in statistics, the mean is obviously just adding all of those up and dividing. And if I have an outlier, which is this massive rise or this massive crash or something like that, it can really change the value of my mean. Whereas the median isn't as affected by outliers. So that's one way that we can use that. Important thing, I can think you can expect to be questioned on that if a mean is being affected by outliers, what can you use? Or what is one way of negating the effect of an outlier? And that would be to use the median, I should say. Significant changes in price over time can really influence. So again, if I set my detrending too long and I've got this massive rise up over 50 odd years, well, that has an effect. So again, the detrending that we're talking about is more saying, let's deal with the primary trends and things like that, and deal with those. See, we have the market that goes up into 2007, down into 2009, and then back up now into, for the last 10 years pretty much. If I went too long and I took from the 50s to now as this one massive trend, and I was using that as my detrending mechanism, I'd be missing out on too much information. So that there's a certain amount of, we've got to be sensible about how we detrend. We're trying to get the primary trend. With the Dow theory, primary trend is what we're trying to identify with detrending processes. And then once we do that, we can go lower and lower and lower and identify other cycles as well. Mainly evident in long data sets. Methods should be used to minimize this. Logarithms, if we are going to use really long data sets or really long time frames for detrending, then logarithms are a way that we can minimize the effect of that. So the first method for detrending that's talked about in the book, and so there were two methods that was said that you need to know. The first one is percentage change. So this is pretty much what we do in our seasonal charts that we just talked about. We look at each of the values, each of the January 1, what was the price? We go to the end of the month. What was the price? Was it a 5% rise, a 2% fall? And we just take it as a percentage change. So that way, when I'm dealing with a security that this January may be $100, but 10 years ago was $10, I'm still just dealing with the percentage changes. And really that's what semi-log does as well for us. But the percentage change is the way that we deal with that. So, and there's an example in the text where I think it was for the price of cotton, measured the percentage changes and then averaged that up. And then from here created an index. Now the index starts at 100 and then we just simply add what is the average. Now I wanted to highlight this because it's unfortunate that we didn't add an extra decimal point in the text, because if I took one decimal place away from here, then the rounding would have pushed that 6 to here, which would have made 29 into 30. And that's why we've got that there. So this is simply just adding. So we start with 100, add January's, and we get 103 if I was using the same rounding. And then we add February's effect into that, and we get 105. We add the 2.6, we get 105.6, and then we keep going. So that's all that's going on there. So for each month, we calculate the percentage change. We find the average monthly change for all Januaries, and then we repeat that for every month. And then it's turned out into a seasonal index by starting at 100 and adding each month's value. All right, the second method of detrending is to use moving averages. Now again, in the text, Kyle's done this all with Excel and created that. I've actually done this in software. So again, if you've got the software, you can download this workbook, you can look at what I've done. So we've put on a 12-period moving average, and this moving average takes the high and the low, which is what Kyle was doing in his calculations, and averages that. So for each bar, takes the high, takes the low, divides that by 2 to get an average for the bar, and then we go back 12 periods, 12 periods, and we average that up. And so we get those values. Then the next thing he does is create a centered moving average. Now, when we deal with our different moving average types, most of them are at this point in time and look back. And so the problem with doing that is that there's a lag inherent in that. So one of the ways that we deal with identifying cycles is using centered moving averages. And so we take the average, and if the average period was 12, well, then we go back 6 periods. And then we get a moving average, which is much more representative for that bar. So that bar 6 bars ago, it's now considering 6 periods forward and 6 periods back. And so that's why it's a lot better at identifying cycles. Now, in programs like Optuma, that last 6 bars is a little bit erroneous. And so we do some regression calculations to try and forecast where we think the centered moving average is going to be. But until we get the next 6 bars, that value is not accurate. Nevertheless, what we've done here is we've said with this blue line, let's take a 2-period average. So we take our 12-period line. From that, we're taking a 2-period value, and it's a centered moving average, meaning that we move it back 6 periods. I want to make sure that you understand the centered moving average, and I apologize if this is a little bit vague. I really do think this is a case where you want to get the software that you have free access to, download the workbook, make sure that you have a look at that and understand that. You may find this calculation to be easier to follow. So this is a script chart. Scripting in Optuma is very much like scripting or writing little formulas in Excel. And in there, what I've done is calculated the 4 calculations that come up with the value or the seasonal factor that Kyle does in Excel in the book there. So the steps that we've done is to calculate a 12-period moving average, calculate the centered moving average, calculate the high-low average, because the index is the distance. So if I take my high-low here and I get a value probably around here, I'm measuring how much higher is this compared to my blue line, which is my centered moving average. And that is what I use. Now, this was a technique that Kaufman used in his book, his trading strategies. Kaufman, fantastic, probably one of the smartest people that I've ever met. Again, a rocket scientist that used to work for NASA. But some of the way that he explained things can be a little difficult to follow. But nevertheless, he sort of talked about this method for creating seasonal charts as well. And just say, okay, let's have a look at the distance up here. And then, we create this seasonal factor from that. And so that's a way that Kaufman talked about detrending, seasonally adjusting price as well. Because it then becomes the distance that this is above the seasonal average. Convert to a seasonal index by adding. So if we wanted to create that same sort of chart like this, we could just add all these values together and we would get that. All right, notable cycles. So now this is getting into what are some common cycles that you just need to know. Print this page out and make sure that you stick it up on the wall and you memorize this. Now there's a couple of new cycles. So when you look at the sample exams and things like that, some common ones that we've talked about for a long time in technical analysis. Obviously the seasonal cycle is 1 year. The presidential cycle is a common one, 4 years. The business cycle, the decennial cycle, and the Kondratieff wave is another one. This is the long economic cycle. We'll talk a little bit more about that. The ones in bold are new ones that were added in the text in 2019. Now the Kuznets cycle is around 18 years. It falls in with the real estate cycle. So, that's another one there to watch. The juggler cycle, that's again around the business cycle length. So I think that these two are pretty much the same, but you need to know them. Now, typically the way questions work in this, it's along the lines of which is the longest cycle, and you have these, or what is the typical length of the business cycle? And you've just got to know. I think it was the Princeton Economic Research that came up with the 8.6 years. So these are just things that you've got to know. Sometimes you can get questions around about the presidential cycle along the lines of which year in the presidential cycle performs the best. And so we'll talk about that in a moment. But as I said, do print this out, just stick it up on the wall and memorize it. So presidential cycles, looking at a bit of a study here on which years perform the best. And we can see that the pre-election year, we've got 13 years we're up, but the average return here, the year before the election, is 11%. Now, obviously, the cynics in us will say that's because that the parties are trying to get as much favour as they can, and they're putting through policies which lead to positive business conditions. The mid-year term tends to be the worst. 2018 was a midterm year, and yes, it did seem to be a bad year. Does make it look promising for 2019 if these numbers tend to hold. So anyway, that's the presidential cycle. It's an important cycle to know. It obviously has an effect because of the influence in politics on business or other way around. Not sure which one influences what. The juggler business cycle, Princeton Economic Institute identified global business follows an 8.6 year cycle. Again, it's an important one to know there. Looking for a low in 2022. Looks like there's going to be a low around 18-19. We're sort of seeing that now. Interesting, this actual image was created in 2011, and so this was all forecast based off that. So far that seems to be holding quite well. Seems to be very accurate, picking bottoms and the major turning points in the market. The decennial cycle, being a yearly cycle, is one that we've seen a lot. This is a little bit different. So before we had a seasonal chart where we're looking at the months within a year. This is looking at the years within a decade. So we go back to the beginning of the 1900 and we look at all of the year zero, so 1900, 1910, 1920, etc. What's the average performance of the Dow in that year? And then we go through and we see that year 5 is typically one of the best years in the cycle. Year 7 is typically one of the worst years. Year 8, year 9 tend to be positive years as well. It might be getting a little bit long, using 10 cycles of data can be a little bit long. Typically 8 is probably about the as many cycles as you want to go back. But nevertheless, it's an interesting chart to look. 7th is usually the worst. 1987, 1997 was another down year. 2007 was an up year, although it was the top, and then we had the down period after that. All right, the Kuznets real estate cycle. So Kuznets didn't call it the real estate cycle, but this is something that I'm sort of putting together because I've worked a lot with this guy here, Philip Anderson. He's got a book out, The Secret Life of Real Estate and Banking. Absolutely fascinating. His 18.5-year cycle. I've known Phil for nearly 20 years now, and in all of the time I've known him and listened to him with his predictions about real estate and the knock-on effects that it has on the stock market. It has been amazing, and he goes back in his book through time looking at previous real estate cycles and the effect that they have as well. Nevertheless, digressing a little bit, if you're interested in real estate cycle and the macro side of the economy there, a great book to read as well there. But nevertheless, it's an 18.5-year to 19 period cycle that you need to know about. Going back to someone like W.D. Gann, so Gann back in the late 1800s defined his own cycle, which was around 18.5 years, and he called that his financial timetable. Now, what's really interesting, so Gann died in 1955, and then he has this cycle, and he had this, you can see this is one that he produced in 1909. He created this list. And so you go through this and you look at years like, here, where are we? J, major panic crash is how he identified this period. And you see 1987 in that period. And then you come into the next cycle of this and you see 2007 in here, 2008, same as A, which was extreme low stock prices, strikes. You remember we had Occupy Wall Street around this time. You know, we get this social unrest happening, and then it continues on again. So again, I just find it fascinating that you have this guy almost 100 years earlier using cycles, and they pretty much worked out exactly as it worked. 2001 tech crash we had. Low stock prices is what he had there. You know, the 2000 panic is what he had there. You know, again, 1997, 98, we had a small crash going on in September. You know, so that's showing there. I find it fascinating. Anyway, again, that's working off the same 18.5-year cycle is what he was doing there. Kondratiev wave, he was an economist, Russian economist. He proposed this 54-year cycle. He'd observed it in the economy from 1780, and you can see, you know, the lows here. So this is his cycle and the way that he expects it to behave, and then the jagged line is the reality of what went on. And so you can see how that's sort of progressed over time. You know, and when we talk about cycles, a 10% variation is completely acceptable. That doesn't negate the cycle. Now, when you're talking about a 54-year cycle, well, a 10% variation is an 11-year window. And so this low here, you know, we could expect anywhere from 2011 through to 2022. In actual fact, we would expect there to have been a translation, and probably the 2009 low was that major economic low that we would expect. Based on his method, we wouldn't expect a significant low like that again for another 54 years, where there was this major depression, you know, definitely strong recession, possibly depression type conditions. All right, so sequences, there's a couple of sequences. Again, everything that we've studied in the last two chapters has been of a fixed nature, fixed cycle length. There's a couple of examples, and the learning objectives talk about needing to know a little bit about nonlinear cycles. So Fibonacci, mathematician in the 1400s, I think it was, but he came up with this number series, and it was the thing that he saw that described so many patterns, you know, in life. So, you know, basically, he would start with 0 and 1 and add the previous two numbers, which gives us 1, 2, 3, 5, 8, 13, 21, 34, etc. And then we have the Lucas number series, where he starts with 1 and 2. I really don't know why, when you look at Lucas, it's always 2 and 1. I've never kind of understood why he starts with 2 and not 1, but nevertheless, he starts with these two numbers, and then the principles are the same. It's just adding the previous two terms to get the next term, and goes on from there. Natural squares is another expanding series that we can use, and I've seen this used in a number of ways in technical analysis, where we just take 1, 4, 9, 16, 25, and so each time it expands out. Gann square of 9 chart is one of the ways that people use to do this and calculate these points on charts. Spiral calendar, Chris Carolyn put out a book called The Spiral Calendar, and that's another one of these examples using Fibonacci, but with the moon cycle as the fixed cycle. So it's a combination, it's an interesting combination of the Fibonacci numbers, and which is obviously an expanding or a nonlinear cycle, and a fixed cycle, and multiplying those together to get these. And so you end up with these waves here that we have. And so again, taking 1987 crash here, you know, we start going forward in cycle length. So again, it's not defining a starting cycle and then measuring off that. It's taking a discrete event in time and then calculating based on cycles forward projection points. And again, you know, some interesting points here, even out into 2015, where we've seen this. Didn't quite get 2009, etc., but then there's other dates that do. So again, it's an interesting way of looking at the market, some very important nonlinear cycles there. Another one which is worth mentioning is the Benner cycle. Now, he was a mathematician slash economist back in the late 1800s. And in his book, which was called The Benner Prophecies, he had this diagram. Now, this was his pig iron. I think it was his pig iron cycle. So he looked at the prices of iron and how they developed over time. And he came up with this pattern. And you'll see that we have from lows, we have a 7-year and then 11 years between lows and then 9 years as well. So he had this period and that just repeats, 7, 11, 9 is what he had there. But then when you look at the highs, you've got 8 years and then 9 years and then 10 years. So a very different cycle. So there's a little bit of translation going on as well. Absolutely fascinating that all the way back in 1884, we've got people doing this type of research as well. So the Benner cycle, definitely worth knowing. It may be worth knowing these numbers, 9, 7, 11 and 8, 9, 10. I think that's probably just worth committing to memory for the exam there as well. All right, so that finishes up the cycle area for CMT1. So explaining how the annual cycle conforms to cycle theory. So that's the seasonality, and then being a dominant cycle and how that works, and then looking at the way that seasonality can be used and how we build a nominal cycle out of the seasonality data. Describe 2 methods of detrending. So that was the moving average method and the percentage change method. Make sure that you're very familiar with those, particularly that centered moving average. That can be a little bit tricky to get as well. If you've got questions on that, remember the forum and I can answer some questions there. Looking at the common seasonal tools that we talked about there, the different tools that can be used. Memorize those the seasonal tools like the Fisher transform. Let's just go back because I'm having a bit of a brain fade there. So we got the detrending data and the tools that we use for that, and those notable cycles as well. Memorize those notable cycles and then recall some sequences and nonlinear. So that's the Fibonacci, the Lucas, the squares, and the Benner. Make sure that you remember those as well. All right, thanks for watching, and we'll continue on with the material next time.